Hello everyone, I am Rakesh from EPK Capital. At EPK Capital, we build wealth for generations. Today, we are tackling a topic that has left many investors scratching their heads recently. Flexi-Cap versus multi-cap funds. With SEBI's latest regulatory updates and their push for tighter rules to ensure funds stay true to label, understanding where to park your hard-earned money has never been more critical. Whether you are living in India or abroad, and whether you are investing a few thousands a month or deploying crores, this video will break down exactly what these rules mean for your portfolio. Let's get right into it. Before we divide this into how it affects different types of investors, let's quickly understand the core difference. It all comes down to one word: freedom. Under SEBI's rules, a multi-cap fund is bound by a strict formula. The fund manager must invest at least 25% in large-cap companies, 25% in mid-caps, and 25% in small-caps, maintaining a minimum of 75% in total equity. It is forced, guaranteed diversification. On the other hand, a Flexi-Cap fund only requires a minimum of 65% in equity. Beyond that, the fund manager has absolute freedom. If they think large caps are the safest bet right now, they can put 80% there. If they want to bet on small caps, they can shift the money dynamically. Now, let's look at how this plays out for you. We'll look at resident Indians first, and then our non-resident Indian or NRI investors. Let's start with those living and earning right here in India. If you are a retail investor, perhaps building your wealth through monthly SIPs, your primary goal is long-term compounding without losing sleep over daily market swings. The multi-cap angle. Because multi-cap funds force a 50% combined exposure to mid and small-cap stocks, they will be volatile. However, if your investment horizon is strictly over 7 years, this forced exposure captures the aggressive side of India's growth story. The Flexi-Cap angle. If market dips make you anxious, Flexi-Caps are usually a smoother ride. The fund manager can move your money into stable, large companies during tough times to protect your capital. The verdict: retail investors who want a fill it, shut it, forget it, core funds should lean toward Flexi-Caps for stability. For our resident HNIs, the game is different. You likely already have direct equity portfolios, real estate, and maybe some private investments. The multi-cap angle. HNIs can use multi-caps as a tactical tool to systematically push capital into smaller, high-growth businesses. The Flexi-Cap angle. Be careful of portfolio overlap. Owning 3 Flexi-Caps might just be buying the same large-cap stocks 3 times. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high-net-worth NRIs. You can download it by clicking the link in the description. Let's continue now. Now, let's talk about our NRIs. Investing in India from abroad comes with challenges like compliance and currency depreciation. You need your Indian portfolio to outpace both local inflation and the depreciation of the rupee. For NRI retail investors, distance makes daily tracking difficult. You are busy with your life and career in a different time zone. A multi-cap fund is excellent if you want to participate aggressively in the Indian market but can't watch it daily. The SEBI mandated 25-25-25 rule ensures you never miss a rally while abroad. The downside of Flexi-Caps for you is that you are entirely at the mercy of the fund manager's judgment. If they miss a market trend, your returns could suffer. And by the time you realize it from thousands of miles away, years might have passed. For hands-off NRI retail investors looking for aggressive growth to offset currency risk, a multi-cap fund provides a highly disciplined, rule-based approach. NRI HNIs are deploying significant capital into India. Your primary concerns are wealth preservation, clean compliance, and minimizing the tax hits that come with frequently buying and selling funds. For NRI HNIs, Flexi-Caps shine. Internal rebalancing saves you from triggering capital gains tax in India and potentially your home country. Multi-caps, being more volatile and rigid, might require you to actively rebalance your broader portfolio more often, complicating your global tax planning. NRI HNIs should heavily favor Flexi-Caps as a core, tax-efficient holding that dynamically adjusts to the Indian economy without triggering personal tax events. In my 2 decades of managing wealth, I've seen market cycles come and go. Here are the 3 biggest mistakes investors make with these funds. Mistake 1. Chasing past returns blindly. Investors often look at a multi-cap fund's incredible 1-year return and pour all their money into it. What they forget is that this return was likely driven by a massive, temporary small-cap rally. How to avoid it? Understand that multi-caps are inherently volatile. Never invest in one with a time horizon of less than 5 to 7 years. Mistake 2. The illusion of diversification. People buy 4 different Flexi-Cap funds thinking they are highly diversified. In reality, because Flexi-Cap managers tend to flock to safety during uncertain times, you might just be holding the same 5 banking and tech stocks 4 times over. How to avoid it? Look under the hood. Check your portfolio overlap. It is far better to have 1 great Flexi-Cap and 1 dedicated mid-cap fund than 4 overlapping Flexi-Caps. Mistake 3. Firing the manager too quickly. In a Flexi-Cap fund, you are paying for the manager's brain. Sometimes, their strategy will underperform the market for a year because they are protecting your downside. How to avoid it? Give a Flexi-Cap fund manager at least a 3-year cycle to prove their thesis. Don't jump ship just because another fund had a good quarter. To sum it all up, multi-cap funds offer guaranteed, structured diversification across all company sizes, but come with higher volatility. Flexi-Cap funds offer dynamic, manager-driven adaptability, making them generally smoother but heavily reliant on the manager's skill. Remember, wealth isn't built by jumping on the latest financial trend. It is built by aligning your investments with your specific life stage, location, and goals. At EPK Capital, we don't just pick funds. We design financial architectures that withstand market shocks and compound quietly over decades. If you are curious about how your current portfolio aligns with these new rules, or if you want to ensure your wealth is truly positioned for the next generation, we should talk. Thank you for watching. Invest wisely, stay disciplined, and I will see you in the next one.